Imagine this situation. A manager casually asks a new analyst, "So, what's our enterprise value?" And the analyst confidently starts explaining market cap. Awkward pause. If you've ever mixed these up, don't worry, you're not alone. Finance terms sound familiar, but many of them mean very different things. Today, we're breaking down 10 of the most confusing finance terms, explained simply with examples you'll actually remember. Perfect if you're studying finance, preparing for interviews, or starting your first role in accounting or corporate finance. Let's start with one of the biggest misunderstandings. A lot of people believe this. If a company is profitable, it must have plenty of cash. Sounds logical, right? But it's not always true. Profit, also called net income, is what's left after expenses are deducted from revenue. This includes non-cash expenses like depreciation, which reduce profit on paper but don't involve cash leaving the bank. Cash flow is different. It tracks real money moving in and out of the business. Picture this. A company makes a big sale in December worth $100,000. The customer agrees to pay in February. The profit appears in December, but the cash arrives 2 months later. Meanwhile, salaries and suppliers still need to be paid in January. That's why profitable companies can still struggle to pay bills. Simple takeaway: profit is calculated on paper. Cash flow is money in the bank. Now let's talk about EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. An easy way to think about it is your salary before deductions. It shows how much money a company makes from its core business before considering debt, taxes, or how assets lose value over time. Why do analysts love it? Because it makes comparisons easier. Imagine 2 restaurants. One has almost no debt, the other has a big loan. EBITDA ignores interest payments, so you can focus on how well each restaurant runs its actual business, selling food and managing costs. The key idea? EBITDA shows operating performance, but it ignores financing and tax realities. Next comes a classic mix-up: market capitalization versus enterprise value. Market cap is simple: share price multiplied by the number of shares. It reflects what the market thinks the company's equity is worth. Enterprise value goes further. It includes market cap, adds debt, and subtracts cash. This tells you what it would really cost to buy the entire business, debt and all. That's why analysts prefer enterprise value when comparing companies. Quick reminder: market cap is about shares. Enterprise value shows the full business value. Now, CapEx and OpEx. Both are expenses, but they behave very differently. CapEx, or capital expenditure, is money spent on assets that provide long-term value. Things like machinery, buildings, or technology. These costs don't hit profit immediately. They sit on the balance sheet and are spread over time through depreciation. OpEx, or operating expenses, are day-to-day costs: rent, salaries, electricity, marketing. These reduce profit immediately in the period they occur. Buy a delivery truck? That's CapEx. Rent one for a year? That's OpEx. In short, CapEx builds the future. OpEx keeps the lights on today. Now let's clear up revenue versus profit. Revenue is total sales. It sits at the very top of the income statement, which is why it's called the top line. Profit is what remains after all costs are deducted. Operating expenses, interest, taxes, everything. That's the bottom line. A company can have massive revenue and still lose money. 10 million in sales means nothing if expenses are 12 million. Remember this saying: revenue is vanity, profit is sanity. Next up, fixed costs and variable costs. Fixed costs stay the same regardless of how much you produce: rent, salaries, insurance. Variable costs change with activity: raw materials, packaging, commissions. This matters because companies with high fixed costs benefit hugely when sales rise, but suffer badly when sales fall. Key point: fixed costs stay put. Variable costs move with volume. That brings us naturally to leverage. Leverage simply means using something to amplify results. Financial leverage comes from debt. Borrowing money can accelerate growth, but it also increases risk if profits drop. Operating leverage comes from cost structure. High fixed costs mean profits rise fast when revenue grows, but losses grow fast when revenue falls. Bottom line, debt creates financial leverage, fixed costs create operating leverage. Now let's compare book value versus market value. Book value comes from accounting records, assets minus liabilities recorded at historical cost. Market value is what investors believe the company is worth today. It reflects expectations about future growth and risk. That's why tech companies often trade far above their book value. Simply put, book value looks backward, market value looks forward. Next is liquidity versus solvency. Liquidity is about short-term survival. Do you have enough cash to pay upcoming bills? Solvency is about long-term health. Can the company survive over time, manage debt, and remain profitable? A business can be solvent but temporarily illiquid, or illiquid today but insolvent in the long run. Think of it this way. Liquidity keeps you alive today. Solvency keeps you alive tomorrow. Finally, ROI and ROE. ROI measures the return on a specific investment. Spend $10,000, gain $15,000, that's a 50% return. ROE measures how efficiently a company uses shareholder money to generate profit. Marketing teams love ROI. Investors watch ROE closely. The distinction is simple. ROI evaluates projects. ROE evaluates the business as a whole. Understanding these terms isn't just about memorizing definitions. It's about knowing how businesses really work, how decisions impact cash, profit, and value, and how professionals analyze financial health and risk. If these concepts finally clicked, you're already ahead of most beginners.